Hi, this is Brett Cenkus with Cenkus Law and Brayton Woods, and today we are going to go through an overview of the merger and acquisition process, the M&A deal process. And I'm going to break it down into 10 concrete steps. Now, in the real world, these steps don't always go in sequential order. They kind of move around and some collapse into others, but this will give you a really good overview of how things, generally speaking, progress and the different sort of important aspects of getting a deal done. And we're going to look at this from the standpoint of the seller, because there are more steps in the seller's process. So in other words, the seller has preparation in choosing the team and figuring out how they're going to market the business and all that sort of stuff. But when a buyer is identified, when a buyer makes an offer that's accepted, now at that point, each of the buyer and the seller have the same steps going forward. So I think it makes sense to look at it from the seller's perspective, but you could really think about it from either. So step number one, if you are a seller, is to figure out generally what you think your company is worth, so you can make some good decisions about whether or not to even walk down this path. And so that's pretty obvious, but it is hard as a seller, particularly if you've been in a business for a long time and it's sort of something that's become a part of you and you enjoy it and you have no need to get out of the business or no burning desire to stop being in that industry, to decide when to sell. So having some idea about what that end result can look like is important. And it would be exceedingly rare to know exactly what your business can fetch. You could talk to people like us who market businesses out of Brayton Woods, or you could talk to business appraisers, you could talk to investment bankers, and they can give you a decent idea. But in the end, as they say, your business will be worth what someone is willing to pay for it. And no two offers will be similar usually. They'll have different structures and things that we talk about in other videos. But in the end, you'll have an idea, if you talk to the right person, about can you sell that business, and if so, what would that probably look like, so that you can at least decide, is it time? Is that enough? Would I actually sell, to make some decisions? Because you need to be committed to the path. It's not a short path. The average business, I think the average business broker I've heard, it takes 9 months, from sort of signing it up and selling it. That seems kind of like a long time to me, but not wildly. 6 months is definitely not nuts. It just takes time. And that's really from the point in time when the bankers or M&A advisors, brokers get involved. So if we're talking about this first step, which is you getting good with valuation and deciding if you even want to sell, that takes place even before that. So time you spend on this, it's time you spend away from growing your business. You have to know that that's worth it and has a high likelihood of reaching an end result that you would be okay with. And getting good with, just emotionally as a seller, the idea of selling the business. So number two, you would want to spend some time looking at cleaning up the back office, or getting kind of your ducks in a row, so to speak. So you will buyers and sellers go through a process called due diligence. And that is the process of a buyer kicking the tires, looking under the hood and figuring out what is really here. And they'll ask you for all sorts of things. It can be almost like just an ongoing root canal of the business. And they want to see your financials and your customer contracts and all these things. That's just how it is, right? So you're getting money and you're walking away, but this buyer is paying money and stepping in. They want to know that what they think they're buying is what they are buying. So that process takes time, and it's really helpful if you go into the process having thought about it a little bit and having gotten some of your ducks in a row. So there's all sorts of things you would look at doing. Some are really sort of simple things like getting your contracts pulled together and organized, making sure that all your files, your contracts and your actions of the board of directors and your meeting minutes and all that stuff is signed, that you actually have copies of all of it. Organizing that stuff a little bit. If things aren't documented but they're supposed to be, you might think about that. If you have customer contracts you've done, orally forever, that's okay. You don't have to have a written contract, but you might think about documenting certain things. If you've got loose ends out there, you've got maybe a former founder, partner kind of person who had some equity and left and things were never buttoned up quite right. That's good stuff to get buttoned up and to deal with. Number one, it will make a buyer a whole lot more comfortable. Number two, you don't have to worry about it once you've already done it, if you're in the middle of a deal. Number three, going to get those kind of things taken care of, if you need another outside party to agree to do it, can be a little bit more challenging when you've got a deal in hand. So kind of looking at your loose ends, Not great to have a ton of litigation. I guess it depends on the business and what the litigation is, and you may not be able to just wrap things up, but you're looking at those kind of things. There are other things that would take more time to transition to, but are super important if you've got a longer runway here. And there are things like buyers really like to see recurring revenue. That doesn't mean every business is sort of built to produce recurring revenue, but most businesses can find some way to do that. So even in my business, we've got ongoing clients and they do repeat business with us, but we don't have booked revenue contractually that's guaranteed in the future. Not much, really none of that. But we could come up with retainer programs, we could come up with information products, we could spend time doing that. In some businesses, they're not doing it and it's even easier, there's lower hanging fruit. If that's your business, you should think about it. Number one, if you don't sell, it's just more revenue, right? But number two, it's a lot easier to sell a business like that. It's really tough to sell a business that does everything they do is oral contracts, month to month. The customer calls us and we just go do work, stuff like that. It's not that you can't sell, but the multiples aren't nearly as good because it represents a huge risk to a buyer. Buyer doesn't know what's going to be around tomorrow. No one is contractually committed. So again, that takes time and it's easier to do in some businesses than others, but you might think about that. And then in every business, you can and should spend time systematizing the business. And so if you run a small business and that business operates around you, everything comes through you. Your employees have to ask you for everything. Can we do this? Can we buy that? You need to step out and make some systems and put some things in place and delegate authority so that the buyer who comes in doesn't immediately recognize that you are critical to this business and may be impossible to replace, or we're trying to replace you represents an enormous risk. There's a gentleman out there, his name's John Warlow. He's got great stuff around this kind of thing. He's got a really well packaged system called Built to Sell, I think, or Value Builder. In any case, he calls it the hub and spoke. And it's this idea that the spokes are the employees and the customers and all that sort of stuff, the vendors, and the hub is the owner. And if that's the case, you got to start working on that today. You don't have to solve and totally change the world, solve it entirely, but you've got to take steps so this doesn't seem to a buyer or you should, only entirely revolving around you. So that's back office sort of stuff. Let's say you got that all taken care of. Now you're ready to go. You're committed to sell. You've got some of your back office stuff taken care of. You need to assemble a team to help you. And your team is at a bare minimum going to be the M&A broker or business broker or the investment banker who's going to help you market your business for sale. That is what they do in the world. They establish a relationship with a selling company. They prepare the marketing materials, the book. They go through your financials. They scrub things. They present it in the most appropriate light. And then they go out and they find a buyer. That's what they do. That's what we do out of Brayton Woods. It's very different than what a lawyer does. The lawyer documents things, negotiates the finer points of the deal. But usually the first call, if you want to sell business, is to the M&A broker or business broker, investment banker. The three words for people in the world who all fundamentally do the same thing. They market businesses for sale. They help buyers and sellers come together and get deals done. It's just a matter of how they position themselves in the world. But they are the people who, unless you find your buyer, unless you go direct, unless you want to market it directly on a website, and you can do that. But, kind of the bigger the deal, the more is at stake, the tougher it is to get done. Agents, they get compensated. Some of them get compensated real well, but most businesses, certainly as you go up the food chain and get businesses out of what we call main streets, businesses that sell for 5 or 10 or 50 million bucks, they have investment bankers and M&A brokers putting those deals together. So you need to find that one. You also need to find a M&A lawyer. So that's a corporate transactional lawyer, business lawyer, but you want one that has, particularly if you're selling a company that's worth a few million bucks or beyond, you want one that's got specialized experience in mergers and acquisitions. It is what we do out of Cenkus Law, shameless self-promotion. Not really. It's you feel free to call me if you got a deal and you want to talk about it, no problem. But that's what we do. We do a lot of it. And so we are a little bit of a generalist. We do other contract work and some capital raising, things like that, but we have a specific depth of experience, I would say, in mergers and acquisitions. I've been doing it for 20 years, and it's just different. It's a different space. And again, if you're selling a company worth a few $100,000, it's really not probably that critical to get an absolute specialist. But as you're selling a business that's worth more and more, it is the moving parts and how those deals go down. It's really helpful to have someone who's really understands that stuff, because it can be a challenging space. I tell people I've been doing it for 20 years, and every day I learn stuff in M&A. It is like that. You're peeling back the onion, and the things I'm learning are pretty darn down the wormhole, right? But it's worth finding a capable M&A attorney. Now, you don't need that attorney right at the get-go. Most times I'm brought into the deal later on. That's going to be the two main people on your team. A third one you should already have on your team is going to be a CPA or a tax advisor, someone who can talk to you up front. And this is the fourth step. After you've got your team, and this person's part of it, you go to step 4, which is planning the process and planning how to sell the business. So on the how to sell the business, what I'm talking about is there are different deal structures. You could sell the assets of your business. You could sell the equity interests. So there's a limited liability or partnership interest or the stock. Or you can do a merger. And Main Street, so business that sell for a couple $1 million, there's not that much merger activity. Those mergers tend to be driven by complex tax considerations, but sometimes they happen. But you've got to figure out what's the right way to do this. Your CPA or tax advisor will be very helpful in that, probably much more helpful than your business broker M&A advisor would be, and more helpful than most M&A lawyers will be. They just have a more intimate understanding of what's going on in your business and what would be the preferred way from a bottom line standpoint, right? There'll be a purchase price and then there's what you walk away with. You're probably more concerned, I imagine, with the walk away, and that requires you to talk to your CPA and think about that and how you're going to structure that. So that's the transaction structure. There's also a planning piece around the deal approach or the marketing plan, the process you're going to run to find a buyer. And there's two big ways you can find a buyer. One is an auction, which is a tightly controlled process where the bankers will, after you scrub the numbers and you rework go through the business, you put together the marketing materials. It's called a book. Usually at that level, it's a confidential information memorandum that talks about the company and recasts the financials and presents the opportunity. When that's all ready to go, on larger deals, very rarely on very small Main Street type deals, but on larger deals where the likely buyer is almost certainly an industry participant, a competitor, the bankers will often run an auction process. And that looks like putting together a list of potential buyers and reaching out to them and bringing them in that way. Usually an auction is run on a timeline of some sort. The bankers, the company, the seller will say that if you're interested, here's how this is going to progress. We need your indications of interest, just like a letter of intent. We'll talk about those in a minute, but we need that by a certain date. Sometimes they have initial indication of interest, then they have final indication, but the point is there's a process. They're reaching directly out to potential buyers, and those buyers are brought through that process. So it's more controlled. The buyers are need to bid against each other. They know that the seller is talking to a few buyers, so it should generate, or is likely to generate slightly higher offers. The risk of it is that, and I've been down this path before, if all the buyers fall out, and that happens for one reason or another, or the buyer you choose falls out, now you're back coming to that group and they've already been run through a process, and it is a little bit harder the next time. Not impossible, and you have the same issue on a negotiated deal, which I'll get to, but it feels like a bigger risk where you run them through if you don't end up at a closing table. In a directly negotiated deal, which is the other type of way to market the business, the seller isn't pitting the buyers against each other. They're not running them through an auction type process. They are just doing a deal directly with a particular buyer. And it doesn't mean they're not talking to a number of buyers up front, but they're not making them all submit offers at the same time, and it's just not that kind of group controlled process. When a buyer comes in, if the offer is sufficient, if the seller wants to dig in and explore selling the business on that, the buyer and the seller will directly do a deal together. So there are times when there's other bidders, but it's not as likely a scenario to end up with multiple bidders as the auction process. Again, in Main Street, if you sell a business for $1 million or $2 million, that's not an auction world. Those businesses often sell to individuals rather than competitors. Someone who's surfing the internet late at night and stumbles across a site called Biz Buy Sell, where a lot of businesses are listed, and just says that's interesting. That kind of individual doesn't buy a $20 million company. And probably don't even buy a $2 very often. They buy a $600,000-$700,000 business, and they're basically buying themselves a job. So some of this has to do with where the buyer's going to come from, how much demand the selling business can represent. The sixth stage is after a buyer's identified, or in the case of an auction, sometimes it would happen maybe multiple prospective buyers in the process. You will sign a non-disclosure agreement or confidentiality agreement, with the buyer. So this is an agreement that says, look, we've given you some basic high-level information. We're going to give you a lot more. We're going to let you dive deep and ask a lot more questions. And we need to know that you're not going to share our proprietary information with anyone. It's a very simple document, but it's a very important document. Either called a non-disclosure agreement or a confidentiality agreement, or NDA for short, for non-disclosure. So now that the buyer is under a non-disclosure agreement, they will be doing some basic due diligence, which is kind of kicking the tires, looking at some basic things. It's usually at this point not full-blown. It can be, and this goes back to my point at the very beginning, which is this process may look a little different depending on who you're working with and what your company is like. But broadly speaking, there will be a point in the process where the prospective buyer or buyers are looking at some of the information around your company. Probably not everything. Sometimes it's a basic introduction, but they don't have super sensitive information and certain types of other information. So that process of basic due diligence is intended, if it's used, to end up with a letter of intent from the buyer, or from multiple buyers if you're doing an auction. But a letter of intent, also called a term sheet, is a document that just lays out for the parties, if we do a deal, here's how it will look. They are usually non-binding, other than for things like confidentiality. If instead of being put into a standalone non-disclosure agreement, sometimes confidentiality will just show up in the letter of intent. That's the first time the parties will have thought about it, even though they really probably should have done it earlier, in my opinion, usually. But that can be included in that. Other binding provisions in a letter of intent, a very, very important one to a buyer, if you could avoid it without a big fuss, it'd be great as the seller, but it's very hard, is an exclusivity clause. And what that says is, we are about to dig in, here's our offer in broad terms, and we're now going to dig in and do a lot more due diligence, spend a lot more money, and have our lawyers prepare documents, and I need to know you're committed. So in the next 60 or 90 or 120 days, it varies depending on the jurisdiction and the parties and their lawyers and all that sort of stuff, but in the next 90 days, let's just say it's 90 days, you would agree as the seller not to market the business to anyone else, not to engage in conversations about selling the business, not trying to bring in a fundamental investor who's going to own a big piece of the business. You're basically on a standstill while the buyer can kick those tires and look at everything they want and decide if this deal still makes sense. And then the letter of intent covers all sorts of non-binding provisions. Those are the deal provisions. That's the purchase price and what the buyer is buying and how the deal will be structured. Remember, we talked about transaction structures. Are they buying the equity of the business, the stock or LLC interest, or are they buying individual assets? In either case, they're buying a business, but it's just legally, for tax reasons and liability reasons, how is the deal structured to get the business and what it is, the assets and operations and all that stuff over to the new buyer. And closing time, things like that. There'll be a lot of other provisions. So some people will ask, well, why do you sign that if it's non-binding? Well, the reason is to be sure you're on the same page, what the deal is, what it looks like, that you fleshed out the important points. You also get the signature, if you're a buyer, you get the signature of the seller on the exclusivity clause. It's really important to know that the seller is not, now that they have one bird in the hand, that they're not going to go out and shop your deal harder and leverage you. So you want to make sure that they can't do that. And then hopefully it makes things go a little bit more quickly, because when the lawyers get involved, the deal's pretty well, at least from a very high level perspective, it's thought out well. So that's the 8th step. The 9th is full-blown due diligence. So once a letter of intent, which by the way could be called heads of terms or term sheet, there's different terms, but usually it's, more often than not, it's called a letter of intent in my world. So then you go into full-blown due diligence. So now that the seller has selected a particular buyer, the seller is under an exclusivity provision, almost always the deal from a high-level perspective. The major points, terms have been fleshed out. There's a lot of stuff in the weeds that hasn't been done yet, but from a high level, the parties are on the same page as far as purchase price and what's being sold and all those good things. So full-blown due diligence is like the basic diligence we talked about before, but more of it. So at this point, the buyer's going to ask for all sorts of things. They're going to see every contract of the business and leases, and they're going to want to see all the financials and all the things they asked about before and more. There might be certain categories of things that they didn't ask about before, like client contracts and stuff. They probably haven't deep dove on every single one of those, but they will now. The buyer needs to understand, and the seller needs to understand as well, are there any issues to transitioning the business? That's something that comes up in due diligence. So many commercial contracts will have a provision in them called an anti-assignment clause. Sometimes it says just can't be assigned at all to a new party. Other times it will say cannot be assigned without the other party's approval. And so those anti-assignment provisions can be a source of a lot of concern depending on what those contracts are, how important they are. We talked earlier about trying to get recurring revenue, trying to get signed long-term contracts, or at least that's more important to have for a business. It's more valuable to have that stuff than not. But if those contracts can't be easily transitioned, and this is technical stuff, depending on the way you're doing the deal, it may be easier with some or not prohibited with some. So just basic, you can't assign this contract to someone else may not be triggered where a new buyer buys the stock of the business. That's not technically an assignment of the contract, but I'm kind of going deep down the wormhole. But this part of the process will be time consuming. It depends. It depends on who the buyer is. We've talked in another video about private equity buyers and what's good and what's bad about private equity buyers. Like, their pros and cons and strengths and weaknesses from a deal perspective if you're a seller. They do a lot of due diligence. Their process can be very methodical, even on smaller businesses. Even a business for $1 million, they just kind of have a process they run through. So it can be a lot of work. Sometimes it can go on for months. It feels like it never stops. But I assure you, there is light at the end of the tunnel. It will eventually stop. And just keep remembering that, number one, the buyer's putting new, fresh money in. They're not just walking away. They want to understand what it is they're buying. They don't know everything that you know. And then oftentimes there's a lot of people on the deal team and the buyer's deal team, and sometimes things aren't communicated. So you might, we already sent this to that person. We already sent it to that person. It happens, So it's okay to come back to a buyer and say, if it's really not going well, to come back to their advisors or directly to the buyer and just say, look, this is not being very organized. Things are getting lost. But again, expect that it's not a perfect, it's not the most perfectly buttoned up process, but it's going the right way. And if a buyer knows what they're doing, it shouldn't be too painful for the payoff. So then the 10th step after the due diligence is done, sometimes even though you're under a letter of intent, the buyer has found something out and they want to renegotiate. So that letter of intent may change on its fundamental terms. Usually the exclusivity clause will prevent you as the seller from changing the terms, but the buyer, everything they're doing is subject to their due diligence. They may come back and say it just doesn't make sense for us to do it this way or that way. But assuming you don't have to renegotiate, or if you do, you come to terms, the next step is to document the deal with a binding purchase agreement and what we call ancillary agreements. But the main document here is the purchase agreement. So it could be a stock purchase agreement, could be, in the case of an LLC or membership interest purchase agreement. If it's a partnership purchase agreement. That's if they're buying equity. Otherwise, it's an asset purchase agreement or a merger agreement. All three are covering the same things. They're covering what's being sold and for how much, and what are the representations and warranties of the buyer and the seller. What are the statements of fact about the business or about who the buyer and the seller are that the other party can rely upon later on. These can be 6 or 7 pages, they could be 60 or 70 pages. They come in all sorts of different flavors. It depends on the deal, depends on the parties, depends on the risk, depends on the lawyers. There's a lot of things that go into it. We try very hard when I do this. If I'm representing a business worth $500,000, it can be really challenging unless for both sides are probably not going to want to pay the lawyers to negotiate a 50-page agreement, and the risk profile of the deal probably doesn't call for it. So we try and be very circumspect and think a lot about how much paper, what do we need to ask for, that sort of thing, depending on the situation, right? What does it call for? So when you get to that point, most deals, certainly in Main Street and the lower middle market deals that sell for $5 or $10 million, a lot of times you'll negotiate that purchase agreement and the parties will sign and close on the same day, like when they're ready to close, when they're all signed off on that purchase agreement. And in other deals, there'll be a signing on one day and a closing later. We call that a two-step or a bifurcated sign and close. The purchase agreement still is kind of the same. It's a very similar document, but in the bifurcated closing structure, there's an extra section in the purchase agreement that talks about conditions to closing. Now, basically things that say the seller can't sell any material assets, can't lose any important customers, can't have any new litigation. There's all sorts of things that make sure that between signing this binding deal and closing, the business doesn't change much. And the reason you would do a sign and close a sign on one day and close on another day is because a bunch of reasons. But the buyer may need to get financing, but the seller wants to lock them down, right, to know they have a firm deal. Sometimes there's a shareholder approval in a public company that takes a long time. There could be antitrust approval for companies that meet those thresholds. That's way over Main Street. So anyway, that deal structure probably was decided back in step 4. But it's documented here in step 10. And when you're all done with all of that, you have your closing, which I always tell sellers these days, they're very anticlimactic. A lot of times we just do it by signing and exchanging electronic signatures, through DocuSign or something. We still get together sometimes, but not like 20 years ago when every big deal was closed in a closing table with lots of lawyers around it and a closing dinner afterwards and all that sort of stuff. Now it's really all the heavy lifting, all the work's been done, everyone's ready to sign. Usually the lawyer's already holding signature pages in escrow, and then it's just a matter of moving the money and being done with it. So those are the 10 major steps in the M&A process. That's a lot to cover. I know it took us a little bit of time. We'll probably break out and do some individual videos on some of these. If you have questions about any of them, please send me a question or leave me a comment. If you want to know more about a particular step, I would reach out. So thanks for listening today.